we are happy enough to have Mr. Gavin Holmes flying all the way from Chicago to be in Malaysia with you guys for a very special chart clinic that we have now. And this is really one session that we've been getting a lot of people to come. And what we've been doing over the past several months, and we really have a very short session on our Traders Truth Review subscriber in here as well, like subscriber. And we really want to do a Friday chart clinic. And as of today, we have a very special guest, Mr. Gavin Holmes, and we want to welcome you to this Friday chart clinic. We will be maybe slightly longer than 30 minutes, so it's all up to Gavin, and he's here to share with you something, what you'll be expecting in tomorrow's seminar, as well as a little bit more about how he looks at the market. All right, take it away, Gavin.
Okay, thanks very much indeed, Martin. Yeah, good morning to you all. Welcome. I'm broadcasting from the hotel room here in downtown Kuala Lumpur, and it's great to be with Martin's group here. So thank you, Martin, and to Bill, who do a wonderful job teaching everybody how to read the charts. And let me start today, actually, by giving you a sneak preview of something. That would probably be a good place to start. And let's put this one up. And what we'll do is I'm going to show you just a little bit about what I'm going to show tomorrow in a lot more detail at the seminar that we're doing here in Kuala Lumpur. We're here with Dr. Gary Dayton, who is a trader as well, and also an expert in the Wyckoff theory. Let me just ask all of you first before I start. How many of you here have heard of a trader called Richard D. Wyckoff? How many of you have heard of a trader who was trading in the 1920s called Richard DeMille Wyckoff? How many of you have heard? Okay, I'll speak a little bit louder as well, Peter, but how many of you have heard of Richard D. Wyckoff? Let me just ask. Okay, so I'm getting a lot of people typing in yes, and a lot of people typing in no, so there's a bit of a mixture there. Okay, all right. Well, everything we're going to teach you, and everything that we do teach, is based on the teachings of a trader called Richard D. Wyckoff. Now, for those of you who don't know who I am, I've actually written 2 books on trading. And the first book is called Trading in the Shadow of the Smart Money. And it says underneath here, use volume spread analysis, which I'm assuming you all know what that is, to understand market manipulation and read charts like the smart money. And that's what I'm going to talk to you about in this very quick session. And we're going to go and look at a couple of stocks that I believe at the moment are being accumulated, being bought by the smart money. Right now, today, buying, now, on the chart. And I've searched several stocks which are undergoing accumulation right now. So a little bit about me. It says in 2002, Gavin had the good fortune to meet Tom Williams, a former syndicate trader who in his early years had traded with one of the largest stock trading funds in America at that time. Tom subsequently wrote 2 books, The Undeclared Secrets That Drive the Stock Market and Master the Markets, which are read by more than 100,000 traders and investors worldwide. Gavin was introduced to the book's author, and at their first meeting, Tom explained that the markets were being manipulated on a daily basis by the smart money. Tom Williams had been a smart money insider and later developed trading system software to discern the activity of the smart money manipulation of the markets, www.tradeguider.com. Gavin later became a protege of Tom Williams and has been a leading expert in market manipulation and the volume spread analysis methodology. His passion is to enlighten those traders and investors who have no idea of the inner workings of the markets. He has also built upon the pioneering work of Richard DeMille Wyckoff, Richard Ney, and Tom Williams. So this is what I'm going to teach this weekend at the event that we're doing. It's a 2-day event, and it's basically one objective is to teach you how to make money when the markets are being manipulated. And rest assured, the KLSE is definitely undergoing manipulation at all times. I've seen plenty of evidence of that. Now, I'm not going to go through all of this for now, but suffice to say, we have customers of TradeGuider that win competitions. This particular gentleman is called Earl Ehrenler, and he won a trading competition. So this is Tim Raymond. And how did he win it? He won it by using volume spread analysis. What is volume spread analysis? Well, many of you, I hope, know the answer to this question because you attend Martin's seminars. But for the purposes of being a bit pedantic, I'm going to go back and reiterate why volume is the key to identifying market manipulation as it happens. So at its core, volume spread analysis, or we'll call it VSA, is a methodology based on the original works and teachings of Richard D. Wyckoff, a trader in the early 1900s who's now passed away. The methodology seeks to establish the cause of price movement on a chart. The cause is simply the imbalance of supply and demand as the market trades, resulting in either strength or weakness in the market being charted. For the correct analysis of volume, you need to understand that the recorded volume contains only half the knowledge required for correct analysis. The other half of the knowledge is found when observing the spread or the range of the price bar. Hence we call it volume spread analysis. Volume indicates the amount of activity on the price bar, and that's important, and you might want to write that down. Hey Martin, I think you've got your mic open. There's a bit of noise in the background. You might want to just close the mic off, just so there's no background noise. So volume indicates the amount of activity on the price bar, and the spread or range of the bar shows what the price actually did on that activity. And most importantly, we're then going to look at where the closing price came in. So volume spread analysis, in its simple terms, looks at three key parts of a chart. But, this is the big but. Let me just mute Martin's microphone because there's a lot of background noise, I think. You can probably all hear that. So let me just bear with me a second. I'll just see if we can... Ah, there's Dr. Gary Dayton. Perfect timing. Let me go and get Gary, and I'll be back with you here in 1 sec. I'll just go and get Gary. Okay, so I'll explain why. Gary Dayton's here. Dr. Gary Dayton, who's also a Wyckoff expert, has just joined me as well. So, volume spread analysis looks at volume at the bottom of your chart. Now, the most important thing to understand about this at the bottom of your chart, the volume, it is the activity of the professional players. You probably want to write that down. You probably want to write that down. It's the activity of the professional players. So volume is activity. Remember that. Volume is activity. You probably need to write that down. Okay, so volume is activity. You may well want to write that down. Okay, so volume is activity. Okay, so if that's activity, if the volume is extremely high, or what we call ultra high, then we know there's lots of activity. If the volume is very low, as on this bar, we know there's less activity. And that is important. Okay, so what we know from volume is that when we see high, or what we call ultra high volume on the chart, we know there is some activity happening. And it's the activity of the smart money. So remember, when you see ultra high volume, I call them Yao Ming bars, and I'll explain why later. We are knowing that the professional side of the market, the big smart money players, are becoming active. So who invented VSA? Well, it was invented by this man. His name is Tom George Williams, and he was born in 1929. He's still alive, and he's in fact my mentor. He says, if you can read a chart correctly, you will understand the markets do not move randomly, but are moved by the smart money. And you can see their intention at support and resistance levels by looking for the telltale footprints hidden in the volume and the price. And then you have a chance to profit by following their footsteps. Volume is vital in your analysis. which is why the self-regulated exchanges around the world will not release true volume figures until the day after the actual trading took place. We're going to show you today how you can read volume, because we don't need actual volume, we need relative volume, as I'm going to show you in some of your stocks. And I've picked a few out that I think have got trade setups coming. And today, I'm not going to spend a lot of time on the trade setups. I'm going to spend time showing why volume is important. I've got Dr. Gary Dayton with me. Now, why is the market going up? Now, we're going to start with a chart of an American market. You should all be familiar with this market. It is one of the leading indexes. It's the S&P 500. Now, the S&P 500, often traded in America as the E-mini, a lot of people trade the futures index, shows us clearly why the current market is going up. What do you all notice? Let me just ask you. This is in August of last year. What do you all notice about the volume on that bar? Is it high, very low? What do you think? Just type in. What do you notice about the volume on the bar that I'm pointing at there? Just type it in. Is it very high, very big? What do you notice? Please do participate, because this is important. What do you notice? What do you notice? Okay, everyone's typing in. It's ultra high, very high, enormously high. Well, you're absolutely right, everyone. Everyone that answered that it was very high or ultra high, it's the highest volume seen for about 2 years. Now, that was the day that the news and the media told us that the S&P had downgraded the US government. And in fact, this was a time apparently for everyone to sell their stocks and buy gold. But in fact, as we now know, for the most part of 2012, the S&P has rallied strongly. And the reason that it has rallied is nothing to do with the news. It's to do with that bar there and that bar there. They're called springs by Wyckoff. And this bar here is where you would enter, as I'm going to show you tomorrow. That is a trade setup. That, and that. So here we have massive volume as the herd, as we call them, the uninformed traders, panic and sell because they hear on the news that because of the downgrade, stocks are going to go lower. They rush out and sell their portfolios in a panic. But the smart money, the professional side of the market, understand this is an opportunity to buy perfectly good stocks. In fact, Apple nearly doubled in value. Apple was a market leader and was a great buy last year. Now, I'm going to show you some of your stocks today in your index. But we notice, and this is a very, very important part, that over here, several weeks later in October, we get the same reaction. A widespread down bar, the next bar's up, and the volume is very, very high, but it's not as high as it was here. And that is a signal in its own right that professional money are now getting ready to push this market up. Because this, ladies and gentlemen, is called the phase A of accumulation. It's the first step of buying. And if you're going to be in Malaysia and make money, you better learn when buying's happening. Because it happens on bad news when the market is falling. We call it down bars. So let me introduce you to Dr. Gary Dayton. Now, Dr. Dayton has been studying the markets for many, many years, and his mentor was a guy called David Weiss. Some of you may have heard of David. And Gary, like myself, is an expert in the Wyckoff method. So I'm going to ask Gary to explain why, on all this terrible news, the market rallied and still today is rallying, and is likely to go up even further with opportunities to buy. And then we'll go and take a quick look at 3 stocks that I'm going to be covering in more detail this weekend, and then we'll hand it back to Martin. So, ladies and gentlemen, could you give a warm welcome please to Dr. Gary Dayton, who will explain why buying happens on down bars. Here's Gary.
Hey, everybody. Let me just do a quick sound check, make sure that you all can hear me all right. Good. Hi, everybody. Sounds okay? Okay, good. Yeah, let me try to. Gavin points out a few things here which are really useful for traders to understand. And I'll use this little red circle here. You notice the very, very high volume. And in fact, on this software, the TradeGuider software, when it gets up into the light blue to salmon colored area, it means that it's abnormally high volume. Okay, so if you all remember, in the American market, the Standard & Poor's 500 index, the S&P, which is what I trade day to day, we had quite a few days of downside movement here in August of last year. And at that time, the news was bad. There was a concern about some of the European countries with their ability to pay back their debt. And suddenly, out of the blue, Standard & Poor's, the bond rating agency, downgraded the United States government bonds for the first time, I think, ever, or certainly the first time that I'm aware of. And so that was very, very bad news, and the market plummets down like this. And the high volume indicates that a lot of people were selling. A lot of people were dumping stocks. Sometimes we call it puking out stocks. They didn't matter where they bought them, didn't matter whether they were taking a loss on them. They just wanted out, O-U-T, get me out right away. And when that kind of cascading effect happens, and we see this major amount of volume coming in, I think Gavin said that it was the highest volume that we had seen in a couple of years. And if you go back to your charts and take a look at high volume areas, you will notice that within a month or two, the market will typically change direction. I would encourage you all to do that on your own, to see that. Because what it means is that there's a transfer of stock going on there. Typically, the public is selling out, and they're unloading their holdings here, and others are in there buying. Certainly this high volume occurring on wide spreads of bars. The spread is the difference between the high and the low of the price bar. And most of these price bars here are closing on or near their lows. That indicates a lot of selling. There's no question about it that there's tremendous amount of selling going on during these couple of weeks. And we know that there's a lot of selling also from the huge amount of volume. As Gavin said,